Before we begin, this video is for educational and entertainment purposes only and is not financial advice. Always do your own research before investing. YouTube script: high-yield ETFs in Canada with more stable NAV. A high yield means nothing if the ETF keeps losing value. And that's one of the biggest mistakes beginner investors make when they first start chasing passive income. Because yes, some ETFs can pay massive monthly distributions. But if the ETF's price keeps falling year after year, your portfolio may not actually be growing. The goal isn't just high income. It's building income that can survive long term. So in this video, we're going to break down some of the best high-yield ETF categories in Canada that investors often look at when they want a balance between strong income, diversification, and more stable NAV over time. And we'll keep everything beginner-friendly. Section 1. What ETF yield actually means. First, let's clear up one of the biggest misunderstandings in investing. A high yield does not automatically mean a better investment. ETF yield simply refers to the income paid relative to the ETF's current price. So if an ETF pays $1 per year and trades at $10, that's roughly a 10% yield. Sounds great on paper. But here's the problem. If the ETF price drops from $10 to $7 over time, that high yield may not help as much as investors expect, because your capital is shrinking. This is why experienced investors focus on something called total return. That means combining distributions, dividends, and price performance together, not just yield alone. Section 2. What NAV means. You'll often hear investors talk about NAV. NAV stands for net asset value. In simple terms, it's the value of the assets inside the ETF. For beginners, you can think of NAV as the ETF's underlying value per share. Now, some income ETFs maintain relatively stable NAVs over time. Others slowly decline. And some can decline very aggressively. This is especially important in high-yield investing, because if distributions are too large compared to what the fund actually earns, the ETF can slowly erode over time. That's why sustainability matters. Not just headline yield. Section 3. Why some high-yield ETFs decline over time. There are several reasons why high-yield ETFs may lose value over time. First, some funds use aggressive covered call strategies. Covered call ETFs generate extra income by selling options on stocks they hold. This can increase monthly cash flow, but it can also reduce upside during strong bull markets. Second, some ETFs are heavily concentrated in a single sector. For example, energy, technology, or crypto-related companies. That concentration increases volatility. And third, sometimes the yield itself is simply too high to be sustainable. This is where beginners can get trapped. A 15% or 20% yield looks exciting, but often higher yield means higher risk. There's usually no free lunch in investing. Section 4. Broad market ETFs versus high yield ETFs. Let's compare a few ETF categories at a high level. Starting with broad market ETFs. Broad market ETFs are usually designed for long-term growth and diversification. Examples in Canada include funds that track the S&P 500, the TSX, or global stock markets. These typically have lower yields, but stronger long-term growth potential. They're often considered the foundation of a portfolio. But many income-focused investors want more monthly cash flow. That's where dividend and income ETFs enter the picture. Section 5. Dividend ETFs with more stable characteristics. Dividend ETFs are often one of the first places beginners look when they want passive income with potentially more stability. These ETFs usually hold established companies that regularly pay dividends. In Canada, many dividend ETFs focus heavily on banks, utilities, pipelines, telecom companies, and large blue-chip businesses. Examples commonly discussed include Vanguard FTSE Canadian High Dividend Yield Index ETF, iShares S&P/TSX Canadian Dividend Aristocrats Index ETF, BMO Canadian Dividend ETF. These types of ETFs generally offer moderate yields, broader diversification, and potentially better long-term NAV stability compared to extremely aggressive income products. Of course, they still fluctuate with the market. Nothing is guaranteed. But many beginners prefer starting here because the strategies are easier to understand. Section 6. Bank-focused income ETFs. Canadian bank ETFs are another popular category for income investors. Why? Because Canadian banks have historically been major dividend payers, and many investors view them as relatively mature businesses. Examples commonly discussed include BMO Equal Weight Banks Index ETF. Section 7. Covered Call ETFs. Now let's talk about the category that attracts massive attention online. Covered Call ETFs. These ETFs usually hold stocks while also selling covered calls to generate extra income. That additional option income can boost distribution significantly. And that's why many covered call ETFs advertise high monthly yields. Examples commonly discussed in Canada include Global XS&P/TSX60 Covered Call ETF, BMO Covered Call, Canadian Banks ETF, Harvest Canadian Equity Income Leaders ETF. Now here's where beginners need balance. Covered call ETFs are not automatically bad. In fact, some investors use them successfully for income strategies. But there are trade-offs. The higher the income strategy becomes, the more investors should pay attention to NAV behavior, diversification, and long-term total return. Some covered call ETFs with broader diversification may hold up better than extremely concentrated or ultra-high yield products. Again, yield alone should never be the only metric. Section 8. Extremely high yield ETFs. This is where things get risky. Some ETFs advertise extremely high yields, sometimes 12%, 15%, or even higher. And while those numbers attract attention, beginners should slow down and ask important questions. Where is the income coming from? Is the strategy sustainable? What has happened to the NAV over time? Is the fund diversified? How volatile is the sector? Because sometimes a very high yield is compensating investors for taking very high risk. And in some cases, investors end up slowly losing capital while focusing only on monthly payouts. This is why many long-term investors prefer balance over maximum yield. Section 9. A simple beginner mindset. For beginners, a healthier way to think about income investing is this. Instead of asking, "What's the highest yield I can find?" ask, "What type of income strategy can I realistically hold long-term?" That usually means balancing yield, diversification, volatility, and sustainability. For many investors, combining different ETF types can create a more balanced portfolio. For example, broad market exposure for growth, dividend ETFs for stability, and selective income ETFs for higher cash flow. Not every part of a portfolio needs maximum yield, and sometimes slightly lower yield with better stability may produce better long-term results. Closing summary. At the end of the day, high-yield investing is about much more than chasing the biggest percentage. Because a high yield means very little if the ETF constantly loses value over time. The key lessons for beginners are: understand what yield actually means. Pay attention to NAV stability. Avoid overconcentration. Think about total return. And focus on long-term sustainability. Some ETFs aim for aggressive income. Others focus more on balance and diversification. Neither approach is automatically perfect. The important thing is understanding the trade-offs before investing. And building a strategy you can realistically stick with long-term. If you're starting your investing journey in Canada, I'm building a simple step-by-step guide on this channel. Consider subscribing so you don't miss the next part.